All right. Good afternoon, everyone. My name is Marissa, and I will be your administrator today. Welcome to the May 2023 First Friday webinar. Today's presentation is titled Uncertainty is the Only Certainty. Our prepared comments during this session will be recorded, so their families who are unable to attend have asked us for the recording. Please note we will not record your questions, as privacy is always a top priority for our firm. Our prepared remarks today will be between 15 and 20 minutes long, with some time left over to cover questions from the participants, along with our standard topic, which is, what is the market missing? If you have already sent us your questions, we want to thank you, because your questions help us understand what topics are truly important to each family we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question in the chat box at the bottom of the screen, or write it down and raise your hand at the end by clicking on the icon at the bottom of the screen, and we will do our best to come to you at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Good afternoon, everybody. Let me take a moment to welcome each of you to May's First Friday discussion. And as always, thank you for setting aside the time to discuss some increasingly important topics, we think. Sorry about that. We're going to go in a slightly different direction today because of the incredible levels of, I would describe as abject uncertainty about the future of our U.S. economy and its impact on our financial markets. So we're going to list and address the most frequent and puzzling questions we hear from some of the most intelligent professionals in the investment world and from some of the most intelligent investors we have in our family office. I want to start by saying I don't recall a period in which there's been such a significant disconnect between the data outstanding and the market reaction to the data. It really is almost as if the global capital markets are trying to ignore the data. Said a little bit differently, the signals or the leading economic indicators are telling us different or difficult times are likely over the next year, while the stock market is focused only on the noise of disinformation. We believe this is creating a really misleading narrative. Here's the problem. The stock market is pricing in an ideal future where inflation returns to pre-pandemic levels below 2%. And while the U.S. economy chugs along, growing at 2.5% a year. This is incredibly unlikely to happen because the leading economic indicators and the inverted yield curve, the two most accurate indicators of future economic activity, are both strongly signaling trouble in our future. And as we discussed in the prior meetings, could be significant trouble in our future. Meanwhile, the stock and bond market are priced as if smooth sailing is ahead and there's nothing to worry about. So the title of this month's webinar, the only certainty is uncertainty, is referencing the outcomes of most current questions. Let me explain that statement. When analyzing the economy, in most instances, economic conditions ebb and flow, and the outcome is nuanced. What I mean is the outcome traditionally offers a slightly different shade of good or bad. Economists describe the ebb and flow of these normal economic circumstances as cycles. We all do. And they're both nuanced and they're expected, yet their timing is often difficult or always difficult to predict with precision. In today's landscape, and for the foreseeable future, the outcome for most economic questions is binary. And that's really weird. It's either black or white. There's little room for error, and this is highly unusual because it creates tremendous uncertainty. There's no shading, there's no nuance because the shading is overwhelmed by the leverage in the US and global economy. This leverage in our system is pushing us towards an all or nothing outcome. In economics, we call it the Minsky moment. So this extreme leverage created by over a decade of lower than normal interest rates has truly become a danger signal. It means the US debt problem will remain a consistent and ever-present source of discontent. Our debt problem is likely to be the source of many problems to come, and we're afraid this is what we're really afraid of is that this will come home to roost all at once. It will be slow to create, and then it will happen all at once. That's bad. So I guess often negative economic conditions created by an overabundance of debt start out slowly, as I just said, and then they unravel very quickly. And the problem is that it gives investors very little warning and little time to prepare. So in the past, when we've talked with each of you, we've used the careless campers in the dry forest analogy, because it too offers a binary event, meaning the careless campers may or may not create a forest fire. If no fire, great, no harm's done. The forest and the nearby town are in great shape. And it was just as if there was no risk at all. You need not prepare. However, if the careless campers do start a fire, the dry state of the forest becomes a horrible event, and it happens all at once. The small spark starts out slowly, and with a little bit of wind, creates havoc, potentially ruining an untold number of lives. So the bottom line of this is that our job here at the Abernathy Group is to gather data, separate the signals from the noise, and help families make intelligent decisions while keeping each family's unique goals in mind. However, before that, our primary goal is to prevent disasters. If a mistake is to be made, it should be made on the side of being a bit too conservative, because making less money is an outcome most families can live with, whereas losing money, depending on the magnitude, may be an outcome families can't live with. So I also want to mention that, again, just to help everybody put our comments today in context, that we have a similar alliance of families in our family office, and each of the families we serve has a fairly similar goal. That goal is often summed up in the statement, I've done well in life, and Steve, I just don't want to have to go back and make it all again. So in today's First Friday webinar, we're going to attack the most pointed questions I've heard since our last meeting. And with that said, let me get to these questions really quickly. So the first question is, will inflation continue to ease, or will it remain stubborn as it continues to recede below 4%? Number two, will corporate America be able to pass along price increases, or will wage and price increases reduce earnings? And if so, how much will earnings decrease? This is incredibly important for everyone that has any kind of assets in the stock market, because earnings dictate prices. And number three, if the Congress agrees to increase the debt ceiling, is this a bullish signal And will the stock market take off on the upside on this event? And so let's just get to this and discuss each of these questions and remind you, just everyone on the call, this is hopefully slated as a town hall format. So if you have any questions, please raise your hand or type the question in the box at the bottom of the screen. We want your comments. We want to make it as interactive as possible. So will inflation continue to ease, or will it remain stubborn as it continues to recede below 4%? So I guess we've talked about this in the last two First Friday events. And the question comes up is, how does one analyze inflationary environments? So we know it's cyclical, and we know how to estimate inflation's most likely pathway, meaning when will it decrease and how long will it take? The method the economics profession has taken that we believe is the most informative and productive is to scan history for insights and look for periods in our history that are similar to today's inflationary challenges. And World War II comes up as probably the most similar event because of the money that's been pushed in by the administration. So most of you will remember this slide from the former First Friday's events. It's from research affiliates. It's their data. And it's important because they looked at every single inflationary bout during recorded history. And they've amalgamated the numbers. They're smart guys. And it clearly shows that once inflation exceeds 8%, history tells us it takes at least 6 years to get back to the 3% level. There's no guarantee. Yet when establishing expectations, a deep look at historical events with their similarities, it's a really good place to start. So as you can see, when inflation exceeds 8%, getting inflation to decline to under 3%, it's never been easy. Never. Not once in history. There's not one single incidence. And throughout US history, it's never been done in less than 6 years. And in some instances, it's taken as long as 16 years. The stock and bond prices indicate inflation will return to under 2% in less than 2 years. That's an incredible mismatch based on history. It doesn't mean it can't happen. It just means that it's highly unlikely. And that's one of the huge disconnects that I'm worried about for anyone that's involved in the stock market. So who's right? Is it history or the stock market? And you guys that know me probably know my answer. No one really knows. However, betting against historical data is probably a pretty much of a losing game. So let's push on to number 2. With wages and real estate and manufacturing costs increasing at 5% plus, can corporate America pass along inflation to the consumer? Or will these cost increases eventually decrease earnings? Again, it's important to know this because earnings dictate current pricing of public securities. So for directional answers, analysts, again, as they did in the last instance, they look to history for similarities, and history tells us during recessions. So this is really important. During recessions, costs are not passed along to consumers. Companies eat it, which means earnings plummet. while in economic expansions, inflationary inputs are more likely to get passed along. It's not always, but more likely. Today, all leading indicators tell us to expect a recession. The only question is whether the recession is mild or harsh. Since the probability of a recession is our base case, it's reasonable to expect earnings to decline. How much will the decline be? Well, we look back as far as the early 1900s, and history clearly tells us the average earnings decline during a recession it's been a bit over 20% on average. And we took out the statistical aberrance. So what does this mean for current market prices? This chart or this graph clearly shows that profit margins became artificially inflated due to the enormous amounts of stimulus which was infused into our economic system by the current administrations. And the chart shows that profit margins have clearly turned down. They've already turned down as far as, in early 2023. You would expect profit margins to revert to the mean, and that is a mean average of about 6 to 8%. And what does it mean to investors? That's sort of the question. So let me just do the math for you. Very simple math that everybody can do in their head. In the next slide, we'll show you what is likely to be the base case if corporate America is unable to pass along the cost increases created by inflation, goods and services, and wages. And you guys who were in the last First Friday meeting saw a rendition of this chart. We've just updated it. So the bottom line here is that the market is pricing in corporate America being able to pass along 100% of the inflationary increases to the consumer. History tells you we're in direct conflict with current pricing. So history says one thing, the market is saying another. This is the part that is really perplexing to me. So this slide shows you that earnings will decline by 20% or more. And if this occurs, as history sort of supports, the stock market is at least 35% overvalued. So is the market's current pricing reasonable, or does history repeat itself? Again, no one knows. However, the odds tell you to prepare for historical events to repeat or to rhyme, as current valuations are unlikely to provide any sort of adequate risk-adjusted returns until current valuations become much less expensive. So let me stop here just for a second and find out if there are any questions that Marissa may have aggregated from the participants. Marissa?
Yes, question from the attendees. What will the U.S. Federal Reserve do if something in the economy breaks or a catastrophe occurs before inflation is conquered?
Ouch. Wow. I think that Chairman Powell would say ouch also. So if something significant in our economy breaks, and I do want to tell you that I think we've already started to see some cracks. When you have 3 or 4 banks that are among the top 5 or 6 bank failures in history all occur within a month, I think that's a legitimate crack. But this is an incredible problem. If we have something that is systemic and serious break, before inflation's conquered, I believe the Fed is going to pivot. They will lower interest rates. If the event is bad enough, we also believe that the Fed will start to push money back into the system again, and just like they've done at every other turning point since 2007. It's really been, on one hand, it's saved us, and on the other hand, it has created the framework for ruin. You might ask, why do we believe this to be the case? And I think the most straightforward way of saying this is that we watch what people do because we think it's a better predictor of future actions than listening to what they say they're going to do. Let me give you some recent detail about that a lot of you, I would bet a lot of you have missed this right here. During 2022, Chair Powell decided to start increasing interest rates in March of 2022. So we've been doing this for about a year and a month or two. In April of 2022, he started to decrease the balance sheet by letting the bonds on the balance sheet mature and roll off into cash. This was significant because it was reducing money by increasing interest rates and by withdrawing money from the economy, actual money from the economy. And it was taking place at a rate not seen since 1980s, when inflation was at 15%. Between April 2022 and March 2023, the Fed decreased the balance sheet by $500 billion, which is significant. This was, I thought, pretty incredible, and most economists applauded the action. Then in March of 2023, we had Silicon Valley Bank fail. First Republic, Signature Bank, along with Credit Suisse, followed in the next few days or weeks. And as a result of these bank failures, the U.S. Federal Reserve infused almost $500 billion back into the system in 1 week. So in 1 week, we replaced 14 months of money being pulled out of the system, trying to get our economy back on track. So when you ask me whether the Fed will act like Paul Volcker and remain determined to fight inflation to the end, or will become accommodative like Bernanke and Yellen, which came before Powell, I would say that based on the actions taken so far and ignoring the tough talk from the last 14 months, at first indication of a significant enough problem in our economy, the U.S. Federal Reserve will pivot and start pouring money back into the system. And that's a problem. Let me stop there and see if that answered the question, or if there are other questions. I think the questioner, I think I know who you are. If that didn't answer it, speak up. Or Marissa, are there any other questions in the queue right now?
Yes, one question was emailed in from one of the family office families. Here's the question they sent in. There have been several U.S. bank failures recently. The CEO of JP Morgan says that with the failure of First Republic Bank and its resolution, the banking crisis is now over. Do you agree?
Wow, that's a great question. Here's how I think I would answer this. We largely agree. Our base case is that the crisis has been averted, or ring-fenced, as they say. The stress on the banking system, unfortunately, is going to remain in high gear, and it's as likely as not to become the source of additional negative events. Don't forget, in 1929, to withdraw your money from a bank, you had to go and get in line. In 2023, to withdraw your money from the bank, millions of money from a bank, you pull out your phone and it's done in 30 seconds. To us, it seems as if those specific failures have been they've been ring-fenced by the FDIC or the government by saying they're going to insure the deposits. However, the increased regulations that are going to come as a repayment, along with the movement away from the regional and the community banking system into the 5 or 10 largest banks, it's going to create much tighter monetary conditions, because the regional banks and the consumer banks, the local banks, they're the ones that originate over 80% of all real estate and small business loans. The bottom line of all this is that as money moves from the regional banks and the community banks into the money center banks, it's going to create tighter monetary conditions, meaning there's less liquidity in the US economy than there was before. Less liquidity increases the probability of recession, and less liquidity increases the probability of a longer and possibly a deeper recession. So there was a study that was released about a week and a half ago that said that they thought that the new regulations on the regional banks and the community banks would be equivalent to about a 25 basis point hike by the Fed. We completely disagree. We think it's more like a whole percentage point or more. It's significant. It isn't going to take people very long to understand that my bank is paying me 0.3% on my money market funds, and over here at this bank, they're paying you 4.5%. And if people can't get that right immediately, then that's bad. That's bad. So, well, let me just go to here. So we're getting late. It's getting longer, and maybe I'm getting in too much detail, and I apologize to that for you all. But let's push on and just get this third question answered before I take another question, if Marissa, if you have one. And here's a real quick question: if the Congress agrees to increase the debt ceiling, is it bullish, and will the stock market increase based on this event? And the answer is, it's pretty clear that the debate over the debt ceiling, it's always contentious. And the US government frequently reaches a settlement before tremendous histrionics and showboating take place. The last time the US government faced a debt ceiling deadline was in 2019, and the issue was ultimately resolved by a bipartisan agreement to suspend the debt until July 31st, 2021. In essence, they kicked the can down the road. It remains to be seen whether Congress, what they will do regarding the debt ceiling in 2023. However, we believe the market has priced in an agreement to increase the debt ceiling. And if there was any upside as a result, it's going to be temporary. It will become a non-event after all of the hand-wringing and the name calling. I hope that answers the question. If it doesn't, step up or ping us. Let me get to the last topic today, which is what's the market missing? This is a really good one. This is a really good one. I would say that I bet 99% of us have missed this. It's a similar topic to the one we just discussed. Meaning it has to do with the effect of the debt ceiling solution, and this could be the straw that breaks the camel's back here with our economy. So what's the market missing? We've seen little in the way of anyone starting to worry about the debt ceiling arguments being successfully negotiated. We believe the negotiations will deliver a debt ceiling increase, and it will come along with the usual days of congressional drama. And the talking heads on TV will love this because they can sell commercials and keep everybody glued to the screen. We went back and did some research on the last time a significant disagreement took place in Congress, the importance of which delayed the U.S. decreasing its debt limits. And this, in turn, each of you probably will remember, it caused the rating agencies to downgrade the credit of the United States government from AAA to AA+, which was probably among the 15 most embarrassing moments in our recent history. Here's the importance of this. This slide graphically chronicles both the delay of the debt ceiling agreement and the S&P 500 pricing impact. As you can see, it's considerable. In black, the black line, you'll see the S&P 500 start to decline significantly in May of 2011. And during June, the market rebounded as talks improved and the solution was thought to be in the making. Then in August 2011, the talks turned sour again and fell apart, culminating in a 20% plus decline in less than 2 weeks. So the decline in the stock market, along with the significant decrease in prices of our US bonds, was not only embarrassing, it was costly. The point of this is let me try to sum it up. The point of it is not that we think a replay of this event is forthcoming, although it certainly may be. The point is, during the last argument, the debt ceiling debacle, the US had under $2 trillion in debt outstanding. Today, we have more than 30 trillion. That's interest-bearing debt, and it's outstanding. It's drawing interest. That's more than 15 times the debt which we had during the last contentious debate. And my point is, if that isn't enough leverage to create some unease, consider this. Just listen to this for just 1 second. The debate, once it's settled, will need to be funded. Now think about this. This means that the US Treasury will need to sell 500 billion to 1.5 trillion in new Treasury securities. Whatever, I don't know what the debt ceiling agreement's going to be, but whatever it is, and the new money that they need, they're going to need to come to market. And the way they do that is to sell bonds and take the money that they get for selling the bonds. With this amount of bond sales going on, it's likely, if not guaranteed, to push down the prices of bonds, which increase the prices or increase the interest rate level. So bond prices down, interest rate up. That's not a good structure. Higher interest rates create, as we know, a slower economy, and this, along with all the other initiatives to slow our economy, promise to increase the probability of something in our economy breaking if we already didn't have enough going on. And if something breaks during the debt ceiling charade, which we hope and pray doesn't happen, the after effects could be significant. Again, this is another one of those binary events. If nothing breaks, all is well. We shouldn't have worried about it. However, if something significant breaks, the cumulative debt in our economy becomes more likely to become a negative factor than anyone realizes today. So in short, we believe the probability of agreeing on the debt ceiling, I just want to make sure we're straight on this. It will be resolved. Lots of name calling, lots of threats. It's the aftermath of the resolution that will likely to become a problem, as selling 500 to a trillion plus in US bonds in a short amount of time is going to be a feat unto itself. And I think that's going to give a lot of families the ability to increase the duration of their bond holdings as bond prices go down and interest rates go up. Now, with that lively and uplifting commentary, let me turn it back to Marissa to see if we have any other questions or comments. And I understand that we've gone over a bit this month, yet I wanted to ensure we covered the important topics that were on our radar screen. And just let me say this in a heartfelt way to you, if there are questions or comments, or if any of the topics today generate some personal ideas or concerns, please feel free to call me. I'm going to be around for a good while this evening and in tomorrow as well. And as always, I can be reached at 917-495-5500. And if there are no other comments or questions, let me wish everyone a fantastic weekend, good health, and lots of interesting times until next month's First Friday webinar. Marissa?
We do have one more question in the chat. Are you
Great.
finding companies with little or no debit to invest in? Sorry, are you finding companies with little or no debit to invest in?
We are. So here's a statistic that isn't well understood. Most economists and market, I'm going to call them big mouths, talk about the amount of debt that's outstanding, and they use an arithmetic mean. They use the averages, which is ridiculous, considering 40% of all cash is on the balance sheets of the 5 largest companies in America. When you start to look at the debt load of corporate America, you need to look at a granular level. And so the answer is we are moving up in quality, which would mean we're moving away from companies that are over levered or companies that need to refinance their leverage over the course of the next year or two. We just don't know what interest rates are going to be. Although if we had to guess, we believe the economy is going to weaken, something's going to break, and Chair Powell is going to pivot and give the world everything again. It's just our continuing saga of every time the corporate world skins its knee, we come to its rescue. And that's not the way the Federal Reserve was structured ever. It was structured to be a lender or the lender of last resort during catastrophes. It was not created to be a caretaker of every nip and nudge of our economy. They need to get out and let us go through our cycles. Let these zombie companies clear. Let them go out of business. I'm not wishing them ill. I'm just saying that if they don't have a good enough business model to exist and to generate worthy profits or how would I say margins, they need to go away. So again, that's more than you asked, but the answer is whoever asked that, call me after this and we can talk about specifics. But yes, we're roughly 20% in the equities market or less, depending upon the family, and 80% in generating ideas that are going to generate income and keep us safe during what I think is going to be what could be a really ridiculous downturn. Marissa?
Okay, just a suggestion for next month, maybe discuss the coming storm in commercial real estate. Office zombies?
Yeah, that's okay. It's a great idea, and I would like to say that I had thought of it before, but we'll do that. I'll take that as a great suggestion. Truly, that'll be fun.
Okay, great. Well, this will end our May 1st Friday webinar. We hope you enjoyed the content, and please send us any ideas you would like to include in June's first Friday webinar. Thank you, everyone. Have a great day.
See ya.